Good afternoon, everybody. Welcome in Europe. If you're stateside, good morning. Hope you've had your coffee and breakfast, and good evening if you're in Asia. Thank you for joining the webinar today. We're going to discuss the evolution of banking as a service, and we're going to look at if you're considering launching a fintech or an embedded finance solution, how a BaaS provider and where the industry has got to today could potentially help you. Hi, everybody. I'm Nigel Sirett. I'm a member of the Vacuumlabs team based here in London. I help our clients around the world design, engineer, and launch fintech solutions and digital banks. As you can probably see if you have your video turned on, I lost my hair through having to work with legacy technology in legacy banks before I discovered this wonderful new world of fintech and digital banking 9 years ago. Enough about me. Let me introduce my guests today. Brad, thank you for joining us. I know it's an early start for you. Would you like to introduce yourself, please?
Yeah, and thank you very much for having me. Super excited to be here. My name's Brad Van Leeuwen. I'm the COO and co-founder of Cledara. Cledara helps companies discover, buy, manage, and cancel the cloud software they use to run their business. We manage about $500 million of annual software spend at the moment. We integrate to 2 banking as a service providers, one in UK and Europe, the other one here in the United States. Before this, I was one of Rails Bank's first employees. So certainly seen banking as a service emerge before there was even a word or a terminology, banking as a service. So excited to be here and dig in.
Thank you, Brad. Very, very happy that you've been able to join us today. Thank you, as I mentioned earlier, everybody who's joined wherever you are in the world. Let's just start, make this interactive. Got a small poll to start. Let's assess who today has actually used and made use and leveraged a banking as a service provider. And if you have, what did you use them for? Payments, cards, savings, lending, rewards, other? Very simple. Open the polling and please respond. Let's see who we've got joining us today. And 63% of people have used the BaaS platform for payments, 13% for cards, 13% for other, which will be interesting, 6% for lending and rewards, nobody for savings. Brad, does that surprise you, or is that pretty consistent with what you would expect?
Well, we haven't had a yield curve since 2008, so I'm surprised that no one's been paying too much attention to savings, and it's hard to do any of the other things without payments. So it makes total sense to me.
So today, our agenda. We're going to take a quick trip down memory lane, just to set the context for banking as a service. Going to look at where did fintech come from, and therefore, how do we manage to spawn banking as a service? We'll look at the emergence, and then look at the alternative models that are available in the marketplace today, before moving on to consider if you are launching a fintech, if you are thinking about an embedded finance proposition, what do you need to really think about before you would engage with a banking as a service platform? And finally, we'll look at anything you do. How do you future-proof it? What do you need to consider today? So it's the land of no regrets. And then in 1 year, 2 years, 3 years, 10 years, you have a future-proofed solution. That's the agenda. So let's kick off very quickly. And we're going to look first, really, the trip down memory lane. Some of you, I'm sure, are very young on this call and probably weren't around. Some sadly were. In the 1990s, the internet was taking off. It was growing, and we saw early banking at home in the US on funky keyboards, and gradually the development of internet banking. But if you think about that, that was traditional banks taking traditional products, traditional services, and just using the internet as a different distribution channel. That changed a bit. Smartphones came along. The iPhone came along. We began to see that convergence of technology, connectivity, and bang, hey presto, what happens? We have a global financial crisis, 2008 onwards. As a consequence, we ended up in this perfect storm. Our consumers, small businesses, they lost trust in the banking providers. And there was an encouragement by the regulators, by politicians all around the world. How can we make this old industry more competitive? And that convergence really was the starting point for the fintech revolution. And what did fintechs do? Let's go after the low-hanging fruit. Let's go after the old and inefficient parts of the banking business model. And we saw the emergence of those early fintechs, and that gradually spawned challenger banks and neobanks. I use that term is used by a lot of people they're interchangeable. Digital first banks, and a few examples here. So we saw the emergence of challenger banks and neobanks. And again, these were beginning now to rebundle some financial services, but very focused on specific segments of the marketplace. Atom Bank here in the UK, a business lender and retail savings. N26 launching as a full consumer bank in Germany and beyond. Starling Bank and Monzo, the two UK poster childs. Oak North, a small business lending institution, all digital first, changing their business model, lower cost to serve, lower cost income ratios. However, the market was hot. At that time, everybody seemed to want to launch a fintech. Everybody seemed to want to launch a mobile bank. What is it I need to launch a fintech or a digital bank? Gosh, if I'm going to distribute regulated products, I need to comply with regulations. I need a license to do so. If I'm going to move money, I need to access payment infrastructure. If I'm going to issue electronic money, it's got to be stored somewhere. I've got to be able to transfer it. And actually, electronic money needs to be backed by real money in a real bank account. And if I'm a fintech that's got a balance sheet and I want to lend it, how am I going to provide that money for others? Brad, if I turn over to you, at this time, that market had converged. Before Cledara, earlier in your career, you were actually in this game. Out of all of those challenges and issues, what was driving your growth at that point?
So, in fact, even before banking as a service, I was an investor and one of the early employees in a company called DoPay, which was helping companies like Uber pay their previously unbanked people electronically, because before us, they had not just taxis, but armored cars of cash going in a lot of places around the world. And to do that, we had to work directly with the bank, because banking as a service didn't exist. And I think the interesting thing about all these points, yes, you require a license. Yes, you require access to payment infrastructure. Yes, you need a bank account to keep all the money in. But the most important gatekeeper to all those things were banks. And I'm sure a lot of people on this call have either worked for banks or have sold to banks or partnered with banks. And it is the hardest thing in the world. I can tell you that the company, Dupay, that I was at, Barclays was actually an indirect investor in us. And we had to go through so many levels of governance to get there. It took us longer than the runway we had as a startup to get through all those levels. They even managed, and maybe because they were cutting costs on models that year, but they even managed to put a photo of me on the cover of their annual general report to the stock market before they even managed to approve us as a customer. And so, look, the big challenge in this pre-banking as a service era was that you didn't have anyone that could speak the same language as you. You didn't have anyone that could assess your risk and your opportunity. And you didn't have anyone that operated on a time scale that was even remotely relevant for a venture-backed startup.
One other aspect, and we know this to our cost, Vacuumlabs, we've spent many years helping build technology stacks for fintechs and digital banks. There's a lot of heavy lifting that has to be done as well. So licensing costs, capital, and technology, that's a challenge. And I think that was the combination that really began the early success of banking as a service. So if we move on, let's just look at some of the alternative models, because again, banking as a service means different things to different people. There's not a single definition. But the easiest way to sum up a BaaS platform is, traditional banks have their products, they originate products, they have back office operations, they have licenses, they have distribution, they have customer, they have a franchise. Fintechs came along, hey, we have a great proposition. We're going to target this segment of the market. We're going to be cheaper, better, faster. How do we do that again? So the BaaS platform was beginning to fill that gap. And the way it was filling that gap, just very simply in the early days, most propositions were either something moving money. I'm providing a digital wallet, may or may not have a prepaid card attached. All I'm doing is allowing people to load up money, put it into a wallet, and use it, a peer-to-peer payment, pay for online shopping, etc. What do I actually need? Well, I need a payment processor. Operations, I'm going to do that myself. But what about the license? Do I have to get an EMI license myself, or could I rent one? Contrast that to embedded payments, where all I'm doing on an e-commerce site, I'm just embedding a payment journey within my customer's shopping journey. I don't need a license to do that. I'm just removing friction for that customer. And it's the same with business lending. If I'm going to lend to my customer, I'm a fintech, I need a license for that. Do I apply for my own banking license? Or can I rent a banking license? With business lending, unlike basic payments, I need a ledger. I need to track who I've lent the money to. Is it coming back? I need to generate fee income. I may leverage a banking as a service stack, or I'll use a core banking system myself. Embedded lending, very, very similar, except I'm probably going to find a funding partner and I'm going to pull in somebody else's money to lend to my customers. And from an operations perspective, yes, you can do that yourself, or you can actually outsource your back office processes. So some very, very different, simple examples of fintech propositions, but each requires different licensing regime, different technology stack, different considerations around operations. And we're going to talk about that later on. Embedded finance was important as well in the journey of the development of banking as a service platforms, because banks themselves originate products, as we said, distribute through their branches, through their digital channels to their own customer franchise. With embedded finance, it's the company, or it's the fintech who actually owns the customer. And the banks began to realize that. So today, as well as the banking as a service fintech platforms that do the heavy lifting for any new entrant, the banks themselves are transitioning into providing banking as a service themselves. Why have that fintech doing all the heavy lifting? Why don't I actually provide that myself? How can I reach other banks' customers with my products and services? So the market is sort of fragmented. And I've just pulled a few logos here. These are various companies that we know very well at Vacuumlabs and some we've worked very closely with. But it's a broad church. Banking as a service is everything from a technology-led platform that connects to payment rails, that connects to card issuing, right the way through to innovative core banking platforms such as a Thought Machine and embedded lending, Evoca, Satago, people who will give you money to embed in your proposition. And if we look and just take a quick tour, because I've pulled some examples here and they all give a different flavor of banking as a service models. Railsbank, and I'll ask Brad to elaborate, Railsbank started with how do we have ledgers where you can store value, whatever that value happens to be, and you can wrap compliance around it, and it will connect to payment rails, to card issuing, and Mr. Fintech, you will only have to sign a contract with one person, us, and you'll only have to integrate with one set of APIs, ours. Brad, did you want to expand on that slightly?
I think that the core realization here was that there were certain things that fintech were good at, right? That was coming up with a differentiated product, distributing it, finding customers, doing marketing, sales. And there were certain things that, were commodity and they shouldn't have to worry about, right? Like, where does the money sit? How does it flow to payment systems? It made absolutely no sense that every fintech or any brand that wanted to launch a product had to figure all this out. And because everyone had to figure it out and they had to figure it out in the same way, and it was going to take them 9 months to figure it out with engineering. So why couldn't we commoditize that layer so that a company building a new product could spend their time, energy, effort, and capital on getting their product to market, finding customers, and iterating real fast. I think one of the interesting bits of Rails' history was we started without a card, and actually it was only, maybe a year or two in that we figured out actually a card was a really important piece. Even the idea of us as banking as a service wasn't a thing at the time. At the time, we were even just calling ourselves Open Banking 2.0 because we didn't know what to call it yet. But what we knew was that everyone building the same stuff didn't make sense. And if we could just abstract that away and let other people do what they were great at and be really great at this thing, there could be a lot of value created.
Thank you. I think a good example here of a company doing the heavy lifting and providing an EMI license and the compliance firewall. Second example, pick Solaris Bank in Germany and now elsewhere in the world. Solaris took it one stage further. Solaris said, we are going to apply for a full German banking license, which we can passport throughout the EU. And we're going to grow our own balance sheet. We're going to have external liabilities. We're going to provide funds. So in the Solaris model, as well as the digital banking and cards that other BaaS providers serviced, Solaris started focusing very much on the lending market. The fintechs, Solaris would provide the cash flow. You are a fintech. You have a segment of the market, or You're corporate. You're a large car manufacturer. You have a big customer base. How can you lend money to them? And Solaris's concept, split pay, consumer lending, and then fronting also introduced another dimension to the business model, the concept of revenue share. You were no longer just paying your banking as a service provider a transaction fee or a ticket, an entry ticket, but you were generating a revenue share model. And as we go through time, more recently, a lot of people, I'm sure on this call will know Starling Bank, who started out as a challenger bank here in the UK and decided to build their entire tech stack from the bottom up. And they'll be the first to admit it took them a lot longer than they expected and was a struggle. But they became a leading UK retail bank and then a small business bank. But last year, they did their first big pivot. They realized that actually it wasn't just the technology stack they'd built, all the back office processes around it. They had automated process after process, lending money, collecting money, reconciliations, due diligence, etc. And they've pivoted initially to become a technology company who just happens to have a retail bank attached in the UK. But more recently, they've gone the whole hog. Engine by Starling, you'll see the logo on this slide. This is their full banking as a service offering. So they're no longer happy just providing agency bank accounts for the fintech, for safeguarding of customer funds. They're providing their entire platform, but also they're providing all the workflow and all the process that wraps around that. And they're targeting smaller banks, smaller existing institutions with their own licenses. So again, an advancement of the model. And that finally takes us to, I suppose, the next logical step. And this is a step that NatWest here have taken in the UK. They have a joint venture with a technology company by the name of Vidino, and they've launched the lovely brown logo. It's NatWest Boxed. The difference here, as well as providing their balance sheet and banking as a service technology platform, they are providing a full business process outsourced service. If you are a large corporate, you're a telecoms company, for example, you've got thousands or millions of telco customers. You'd love to offer financial services, help them finance cheaper handsets, better subscription plans, whatever it happens to be. But you don't want to run the back office of a bank. This is the next logical step, is going from technology and licensing through to lending and the balance sheet to the complete back office process. Just before we go on to the poll, Brad, you've had a ringside journey observing that transition in the marketplace. Any thoughts on the direction before we go into the poll? I won't ask you to answer the question directly, but
sure. I think what you've shown there is that banking as a service has been in experimental mode for a lot of years, right? They're still trying to figure out what is the model that makes sense, and there are some forks in the road there. So one of the first forks was, should you be an e-money issuer or should you be a bank, right? So on one hand, Rails Bank took the e-money side. The other people took the other way. So Starling and Clearbank in the UK and Solaris decided to go the bank route. Now, the hypothesis at the time, one of which maybe proved to be true and the other one maybe proved to be untrue, is that you needed to be a bank to access the payment system. Banks were always gatekeepers at the time. And so therefore, maybe being a bank was the best way to do it. And certainly ClearBank, called ClearBank because it was the first new clearing bank in the UK in, I think, 100 years. But actually, TransferWise proved that to be wrong. So TransferWise convinced the Bank of England to become the first technology company to get direct access to faster payments and backs without a bank intermediary. Rails Bank was a fast follower there. So that proved to be not a good reason to be a bank. But the balance sheet certainly proved to be a good reason to be a bank. The other challenge the banks had is because of the way banks are regulated differently to e-money institutions, it was much harder for them to go to other markets. And I think that comes through in NatWest's different model that we saw on the last screen there. But I think there was a few interesting steps along the way. You spoke about Starling Bank. It's interesting they've launched banking as a service, because I can tell you that's the 5th time they've launched banking as a service, probably in the last 7 years. And the reason it's been launched so many times is that, well, 2 reasons. Number one, they're a bank. They're very banky, right? They have great tech, but they don't know how to talk to fintech. They don't know how to manage their risk, and they've always struggled trying to figure that out. Number 2, because as you said, they're also a retail bank. They're also a small business bank. And so they're competing with most, or if not all, the companies that they're likely to onboard to or the fintech companies, and maybe potentially other banks they're looking to onboard to their service. And so it's been a really hard value proposition for them to sell versus someone like Solaris, which says, okay, this is the bank that we're going to build, and this is the purpose. Griffin, that recently got their banking license, David Jarvis there and the team are doing a great job saying, actually, maybe there is a reason to have a regulated bank beyond access to payments. The balance sheet can be really valuable, particularly in a world where we have interest rates again. And so he's doing a great job there, but they're not competing with their own customers. And so I'll be very interested to see how NatWest's iteration of that evolves. What's super exciting about it is we live in a world today where borders, I'm an Australian that's living in London, currently in Denver. Borders mean nothing anymore, except if you're a regulator. Customers don't care about them. And so if you can build infrastructure that abstracts that away, the same way that you can have a Facebook account that operates anywhere in the world, you should be able to have a very, like the same financial services stack wherever you are in the world. Because the idea of borders have gone away in most technology products we interact with every day.
Thank you. Let's have another poll. So, should traditional banks be in this space? 21% people say no. Nobody said no because it would increase systemic risk. 79% of people, yes, it's a sensible distribution channel. Anything surprise you there?
I think, no. I think that, we live in the age of the internet, and the key differentiator in a commoditized product is around distribution. And so banks that want to continue to grow in this market, they either need to be JP Morgan and get mates rates when banks fail and acquire deposits that way, or they need to have some other strategy. And the truth is that banks are not geared up to iterate as fast in a world where distribution is internet first. And so if they can find ways to extend reach, grow their balance sheets, grow their P&L, they totally should explore them. And I think actually with regards to risk's an interesting question, because banks are very good at managing homogeneous risk. The interesting thing about introducing tailored products is that the risk and behaviors of customers are different. And so banks may even not be the best place to manage that risk, and potentially with the right governance structures, actually the companies originating those customers and serving those customers may even be the best place to manage the risk as well.
So let's move on. The world's a different place. Fintech is a different place. Bank propositions are a different place. So today, bringing this up to date, what do I need to consider if I'm launching a fintech or an embedded finance proposition? Some things don't change. Who's your customer franchise? First and foremost, is it a franchise you already have? Is it a franchise you're going to be acquiring? And then what's the detail of the proposition? Are you still just storing and moving money, making loans and collecting savings? Is it an investment proposition? Is it a crypto proposition? Is it a loyalty and rewards proposition? What else is going to be there? Because the answer to that will dictate the direction you need to go. I think as Brad outlined, some of the decisions he faced, do I need to rent a license or do I need to apply for your own? If anybody on the call has been through the process of acquiring their own license, whether it's EMI or whether it's a full banking license, it's time consuming. It typically costs a lot of money in consulting time. And there's a hell of a lot of back and forth with the regulators. Secondly, capital. There's a triage here. Do I need to spend more money up front, or do I need more capital on an ongoing basis? There are significantly different capital requirements between somebody with a banking license, somebody with an EMI license, and a fintech that's just moving money, where the regulatory capital is less around customer risk and more about just the risk of the organization's ongoing concern. And as I just mentioned, from a compliance responsibility, supervisors out there in Basel, we're up to Basel 3, it will be Basel 4 soon. Know your customer, know your customer's business, anti-money laundering, we can go on and on. How much responsibility are you willing to take yourself? How much are you prepared to delegate to your banking partner or your banking as a service partner? They're the primary considerations. Brad, have I missed anything significant in your experience? When you went through that process with Cledara, how did you ultimately weigh up the trade-offs here and go the way you went?
I think early on, our priority was to test our concept, right? So everything that wasn't writing code and finding someone to pay us for our product wasn't a priority. And so we were willing to offload anything to anyone else that would take it, right? So, and that meant we did work with banking as a service providers. We didn't really think about any of these things because these were all secondary early on versus just getting our product to market and see if we were onto something or wasting our time. Because of that, we were able to get a card product to market in less than 3 months, literally from like filing the papers at company's house, putting some Post-it notes on a wall to figure out exactly what the product's going to do, to having our first customer. And so that, I think, is that was our number one priority. And I think I'd probably still today encourage early stage fintech to take the same approach. I think though you do have to think about what trade-offs you're making, because there is a lot of lock-in with banking as a service, and banking as a service itself is in a time of flux right now. I think we'll dig that into that later, but just looking at one line here as an example, regulatory capital is an interesting thing. In fact, all capital is an interesting thing right now, because we're in a world where interest rates are higher, but also the cost of capital, cost of equity is higher. And it didn't matter so much when banking as a service was nascent. They were also just trying to find customers. But now that capital has real cost, a cost that's going up. And there's not only the regulatory capital for the banking as a service provider's e-money license that they're renting out. There's, the the collateral that you need to hold with the card schemes, right? There's the collateral that potentially, if you're connecting directly to payment systems, that you need to hold in your settlement account with the Bank of England. All that capital needs to be provided from the banking as a service platform in a way that correlates with the fintech growth. But the fintech company is not paying that cost of capital. The banking as a service company is, and it's unclear to what extent that's scalable in this rate environment.
So going back, same logos that we talked about previously. If you engage, how do you future-proof your solution? In the early days, in the fintech world, there was a gold rush, and there was a lot of technology debt. There was a lot of short-term tactical decisions taken. Why? It's different with functionality that you're going to release through time, but from your core architecture, your core solution, if you design it right and you architect it right on day one, we're in an API-centric world today. Vacuumlabs, this is what we spend our time doing in the early days with new clients. We make sure something is architected so that it is future-proofed. One, it's scalable. Whether you're a consumer-facing, business-to-business, working in the SME space or anything else, how's your business when it takes off? But more importantly, you plug in a lot of services. We've mentioned KYC and AML as examples, transaction monitoring. Any of these services you pull in, what's flavor of the month this week? Where did you get a good commercial deal? 1 year's time, 2 years down the road, there's something better in the market. Maybe there's something that's not better, but it just is going to give you a much better commercial model. If you architect and design well on day one, it becomes a plug and play environment. The ability to switch in and out a service provider is incredibly easy. So whether you're going to use a banking as a service platform, as in this example, where the platform itself is providing your digital wallets, your transaction compliance, your core, it's done the heavy lifting around your card payment and lending processing, or you're setting up as a bank, as a pure digital bank, and you're using a state-of-the-art core banking solution. This happens to be an example from Thought Machine. It's the same philosophy. Wrap the architecture, design it well. In this example, it's microservices centric, but we're still in that API world, and things still become plug and play as you scale that business. But there's one other key dimension of protecting yourself against the future. And this is a hard conversation to have. I'm sure many of you on the call are aware of the scandal that was Wirecard. 2 years, going on for 3 years, 3 years ago now. The impact of that, when the regulators closed down Wirecard one weekend, any fintech who was relying on Wirecard to process, their customers could not use an ATM machine. They could not access their digital wallets. They could not move money. So the first thing you have to ask yourself, what's the level of risk I'm prepared to run as a business? What contingency do I need in place? We were very lucky. One of our showcase clients, Vacuumlabs, happened to use Wirecard as their processor. We had teams in over a weekend of 24/7 to switch to another provider. It was architected well, it happened, but do you want to run that risk? Is there a trade-off? Should you have a contingency in place? I hadn't personally thought more about that until recently. And we found the regulators in Lithuania concerned about some money laundering failures. And this impacted multiple firms. It impacted Railsbank's ability to onboard new customers for a period of time, and it had a knock-on effect with other banking service platforms. The question, how much risk do you run as a business, and how much are you prepared to pay commercially to have that contingency in place? The best contingency is to design well at the beginning so that flipping the service in and out is incredibly quick to do. But if not, none of us would run a data center without having a standby, hot or a cold standby. Are we really going to rely on one single point of failure? So I will ask Brad, sadly, this particular example is a bit close to home, but any thoughts on single point of failure?
Yeah, I think, when you're, as I said, when you're starting out, you just have to get going. But, if you build a business that works and you start to scale, the next thing you have to think about is, the scalability of your vendors, the resilience of your vendors, and where the risks are. And I think totally agree with the way you architect your product from a technology standpoint. There's a lot you can do there by thinking ahead to make it more hot swappable. I think the challenge that's not talked a lot about here is, whilst the tech side, you can swap things in and out. On the payment side, it's way more complicated. So migrating issuers, doing a recarding, changing payment addresses, so IBAN, sort codes, account numbers, SWIFT things, informing your customers. You can't it's very, very hard. In theory, you can migrate cards. It kind of works. We've done it, but it doesn't always work. It's not easy to do. It's almost impossible to migrate account numbers. And so on the payments layer, it's tough. And so as a business, as you grow, you need to think about, what risks are you running? Are you comfortable with having venture-backed infrastructure in your supply chain that's that critical to you, right? Are you comfortable? Like, you can be really comfortable with the way you manage risk. I can tell you that, though we're not required to, we run a full risk function for our UK, European, and US businesses in-house that is first line. We do it all. And the upstream from us, they do it too, but it doesn't matter because we've already done it, right? And so we take responsibility for our risk, but you can't control the risk that you're commingled with. And the reality is that all of these banking as a service platforms and all these companies that are providing this infrastructure, they're incentivized to grow. You're commingled with other types of risk that maybe you yourself wouldn't take, and you can be caught in the crossfire. And so I think that as you grow, certainly architecting your system correctly is a good thing. Integrating to multiple banking as a service vendors to mitigate this risk is one thing that you can do. But actually, I think that as you scale, you probably want to be more in control of your fate. And so whilst you might still use banking as a service providers, maybe you end up building your own infrastructure. So you can own from the customer all the way back to clearing. You're in control of your risk. And if you get a red card or a yellow card from your regulator, it's your own fault. And it's not, like what crypto company was also using that same vendor.
Thank you. Some wise lessons from a practitioner. Final poll of today. Never say never, but will there be further issues? And if yes, are they going to be AML scandals? If yes, not AML, but something else? Or are we all confident in our ecosystem that the global regulators and the industry is wide awake, and we are learning from our past? Okay, let's share those results. I suspect nothing surprising to anybody there. over half of us feel there will be some further scandals. Okay, let's not end on a pessimistic note. So, thank you everybody for joining us today. Appreciate everybody's time is valuable. We're going to have a Q&A in a moment. I always say if you join any webinar, any conference session, if there's 3 things you take away that you didn't know before, it was a great use of your time. If there was one thing that you take away, you go, wow, I need to do something or change something tomorrow, then it really was a good use of your time, and you'll probably come back next time. I'd just like to end up in a wrap up. First of all, if anybody out there wants to have a consultation and wants to chat through any aspect of anything we've talked about today, please don't hesitate. Contact me directly, phone, email, LinkedIn. Brad, are you phone, email, and LinkedIn reachable?
When I started working, phone calls used to be things you made, and now they're things you schedule. I'm available on Twitter at Brad Van L. You could email me, brad@cledara.com. Always happy to help.
Thank you. And my colleagues internally who've done such a great job making sure technology works and getting everybody here to attend, they will hit you all up with a survey. We want to continually learn. We want to deliver content that adds value to anybody who attends. So feedback, good, bad, and ugly, please complete the survey. So it just ends for me before we move on to Q&A to say really big thank you, Brad. It was wonderful having somebody who's not only a co-founder and has got a wonderfully successful global business, but somebody who had that ringside seat in the early days of banking as a service as well. So thank you for your insights. Absolutely invaluable. The Q&A, you can open the Q&A, anybody in Zoom, and ask a question. Have discussion if you want in the chat channel. But maybe if I kick off here, first question. Already interesting that no one on the webinar has used BaaS for savings. Is it possible to build a startup savings proposition that makes money? I will give my 2 pence on that. It is possible to build a savings platform, particularly if you can reduce the cost of onboarding a client, for example, only having to go through KYC once and then have the ability to invest those savings in multiple products, in multiple banks, in multiple fintechs. So purely in terms of picking up a few basis points of savings, yes, you can, but it's a fine margin game. In terms of launching a neo bank, the name of the game is, where can I lend it? And we're in a very low rate environment at the moment where net interest margin is squeezed. So being purely liability led is more of a challenge than normal. You don't want to be buying government bonds and paying having a negative carry cost. Brad, I don't know if you've got a different opinion.
Yeah, so I think the question is what do you bring to the table that's something different, right? Like a commodity product in a noisy market, it's going to be a hard sell. But a great example, I think, of something that can really work is how you think about savings. And one great example was Mercury Bank here in the US. They're like a startup SMB focused neobank, and the weekend after Silicon Valley Bank had their issue, they worked with their underlying actual bank, Evolve, to do 2 things. So first of all, how do we launch a savings product that there's a benefit for? So maybe some interest. And number 2, how do we increase the level of FDIC cover? So in a weekend, they spun up a product, and in that same weekend, they attracted somewhere between $2.5 and $3 billion worth of deposits, because they made a product that wasn't just what is the interest rate, but what is the problem that it's solving. So I think there is a real opportunity to build these products, but you really need to understand like anything in technology, you need to understand what pain you're solving, how you differentiate, and what new you can bring to the table.
Is the market ready for another wave of BaaS supported fintechs? Aren't we fully in a crisis at the moment? I think, again, from my perspective, you're right. We're in a challenging economy, but look back through history, the number of successful companies that have been launched during a downturn. Short answer.
You know, if anyone's seen the NASDAQ since September, it's going up and to the right. You wouldn't know it by, reading VC Twitter or, reading newspapers, but actually we're in a bull market again, and, things are on the way up. We see in our data even the businesses are spending. So software spend is growing again. It's turned the quarter in Q1. We're back to go. It's going to take a little while to figure things out. But whether it's like a banking as a service fintech, a technology product, or a coffee shop, right? There's so much demand out there right now if you have a differentiated product that solves a real problem.
If utilizing pre-configured underlying correspondence through the BaaS into payment rails, etc., is there a risk that the appetite for certain client types is out of the control of the BaaS user, i.e. the BaaS user doesn't have a direct relationship with the correspondent bank that ultimately processes the payments in and out? I suppose in summary, the issue of the client is owned by the fintech or the intermediary company. The bank doesn't own the customer, but they're processing. Where's that risk really sit?
When you're small and starting out, yes, this is a risk. Yes, you run the risk. No, it doesn't matter because you've got a product that no one knows about and no customers. Somewhere between starting there and becoming as big as PayPal, you need to manage that risk, right? You need to make sure that you manage it, you mitigate it, you do everything that you can. And I think we've seen this through the news with Railsa, right? There have been some companies that, unfortunately, some fintech companies will be killed because of it. Some companies have gone on ice, and other companies that have been aware of the risk, have mitigated it, like us, have kept on going and kept on growing. And so, you just need to know what risks you're running, where you're at your journey, and when you allocate capital to mitigate that risk.
There are a lot of BaaS providers. One recent report identified 20 in the UK alone. Yet there aren't that many services running on BaaS, and a few have already closed down, like MoneyU. Why are there so many providers, but so few marquee services? Or maybe if I add to that question, are we now at the commoditized end of the market? Is there really anything new, any innovation?
I think we're still in that experimentation phase with BaaS, right? So there's a ton of companies trying to solve this problem. It's a real solved problem. The category's validated its need to exist. We don't know yet what the winning business model is. We don't yet know what the winning product is. But there's experimentation. But I would challenge the idea that there's not a lot of winning services on it, right? There's a lot of products that are or will be running on it that they're not fintech actually anymore. It's about brands. I was in New York maybe 4 weeks ago now, talking to one of the largest brands here in the United States that's thinking of launching a fintech product extension, and they're doing it with a banking as a service vendor because like a small fintech, payments and banking is not their forte, and they need expertise on that, and they want to get to market real fast. And so I think there's a lot going on that we don't see on VC Twitter. TechCrunch is not writing about, but there's way more happening in banking as a service and way more customers using it in so many different use cases, verticals, sizes than is in the popular knowledge.
Thank you. We've come to a full stop. If I didn't get around to your question and you asked, please feel free to follow up. So, couple of reminders. Number one, there is the survey link. It's in the meeting chat. Again, your input and feedback will be valuable to us. And going forward, anything we can do, myself or my colleagues here at Vacuumlabs, please reach out. It doesn't cost any money to have a free consultation. Use us as a sounding board. We're very happy to either help explore proposition and give feedback and input. We're happy to make connections across the ecosystem. Happy to build something for you if you want to build something. And likewise, let me wrap up once again. Brad, thank you very, very much. Appreciate it's a very early start in the time zone, but really appreciate your insights. And again, find Brad at Cledara.com. And if anybody, particularly if you're listening and you're in the tech or the fintech environment, you want to manage your subscriptions, manage your SaaS software, Cledara is the platform. And I'm not saying that just because we help build it and we continue to help. They're a wonderful showcase client and we love the relationship. Thank you very much, Brad. And for everybody who attended, thank you. Have a great lunch if you're in stateside. Have a great early evening in Europe. And if you're in Asia, hopefully you're tucked up in bed by now. Thanks, everybody. Take care.
Thank you very much.
Bye-bye.